If you have spent even 5 minutes looking into how to retire without going broke, you have run into the 4% rule. It is the holy grail of personal finance. It is the bedrock of the FIRE movement. The math is seductively simple. You take your pile of money, you withdraw 4% in the first year, adjust for inflation every year after that, and you are set for 30 years. It sounds like a law of nature, but here is the problem. That rule is based on math they effectively stopped teaching after the 2008 financial crisis. We are living in a completely different economic reality now, yet millions of people are still betting their entire future on a calculation that was perfected when a gallon of gas cost $1 and bond yields actually meant something. If you ignore how the math has changed, inflation and market volatility will eat 40% of your purchasing power before you even hit your 70s. The original math was pioneered by William Bengen in 1994. It worked beautifully for a world that no longer exists. Today, we have to deal with zero interest rate legacies, the brutal awakening of 2022, and a sequence of returns risk that is more aggressive than it has been in half a century. I have been running these numbers lately, and what I found is that the old boilerplate advice is not just outdated, it is dangerous. We are going to break down the specific calculation updates you need to make to your safe withdrawal rate right now. Before we dive into the wreckage of the 60-40 portfolio, I will say this. The best return on investment you will get today is hitting that subscribe button. It costs you nothing, but the financial literacy we build here can save you hundreds of thousands over a lifetime. Let us look at where the 4% rule actually came from. To understand why the old math is broken, we have to look at what William Bengen was actually thinking back in 1994. He was not looking at the easy years. He specifically went hunting for the worst-case scenarios in modern history. He looked at the Great Depression of the 1930s and the nasty stagflation of the 1970s. He wanted to find a withdrawal rate that could survive a financial apocalypse. What he found was that even if you retired on the literal eve of the 1929 crash, a 50-50 mix of stocks and bonds would last 30 years if you stuck to that 4% number. It was a brilliant piece of research for its time. It gave people a sense of certainty. But as I read through his original paper, I noticed 3 hidden assumptions that the financial industry has largely ignored for the last decade. Assumptions that are currently crumbling under our feet. The first big assumption in the 1990s was that bonds actually did the heavy lifting. When the 4% rule was being codified, intermediate-term government bonds were yielding between 5 and 7%. Think about that math for a second. If your bonds are paying you 6% and you are only withdrawing 4%, you are not even touching your principal. You are living off the interest and still have 2% left over to combat inflation. Bonds were a massive, stable engine of growth. In that environment, the 4% rule was not just safe, it was conservative. Many retirees ended up dying with double their original wealth because the bonds were doing all the work. But as we will see in a moment, the era of easy yields ended abruptly in 2008, and it left a massive hole in the traditional retirement portfolio that most people tried to fill with pure risk. The second assumption in the old math is what I like to call the robot retiree. The 4% rule assumes you are an unfeeling machine. It assumes that if the market drops 40% in year 2 of your retirement, you will blindly increase your spending by the exact rate of inflation anyway. If the price of eggs doubles and your portfolio is bleeding, the math says you should just keep on spending more. In the real world, that is not how humans work. We feel the pain of a market crash. We see the grocery bill. But the original math did not account for psychological flexibility. It treated retirement like a flight on autopilot, even when the engines were on fire. This lack of flexibility is exactly what makes the static 4% rule so fragile in a volatile environment. You cannot just set it and forget it when the macro environment is shifting this fast. The third pillar of the old math was the belief in the mean reversion of stocks. The assumption was simple. If stocks crash, they will eventually bounce back fast enough to save you. while those high-yielding bonds act as a shock absorber. This worked well in the 20th century, but as we move into the 21st, we are seeing longer periods of stagnation and higher valuations that make those recoveries less certain. When the Shiller price-to-earnings ratio is at historic highs, as it has been recently, the math of buying the dip to save your retirement changes completely. If you retire when stocks are priced for perfection and bonds pay nothing, you are walking a tightrope without a safety net. This is where the 2008 crisis fundamentally altered the chemistry of the retirement portfolio. It forced us into a world where there was simply no alternative to risk. If you think the death of high bond yields was a problem, wait until you see what the zero interest rate policy did to the very concept of safety. After the 2008 crisis, the Federal Reserve slashed rates to near zero and kept them there for over a decade. This created a phenomenon known as TINA, or there is no alternative. Because bonds were yielding 1 or 2%, which was well below the 4% you needed to survive, retirees were forced to take on massive amounts of risk just to keep their heads above water. They shifted heavily into dividend stocks, real estate, and tech-heavy portfolios. For a decade, it looked like they were geniuses, because the market was on a historic, quantitative easing-fueled run. But this era created a massive distortion in the math. We were using a withdrawal rule designed for 6% bonds in a world where bonds paid nothing. It was a house of cards waiting for a breeze. During this zero-interest era, some of the smartest researchers in the field began sounding the alarm. Experts like Dr. Wade Pfau and the team at Morningstar pointed out that the 4% rule had never been tested in an environment where interest rates were zero and stock valuations were at record highs. If you retired in 2021, you were facing the ultimate mathematical nightmare. Your bonds provided no income, and your stocks were so expensive that their future returns were almost guaranteed to be lower than historical averages. This is the moment the 4% rule officially broke. In fact, back in 2021, Morningstar calculated that the safe withdrawal rate had actually plummeted to 3.3%. If you had $1 million, that is the difference between $40,000 a year and $33,000. That $7,000 gap is a lot of missed vacations or medical security. Navigating this kind of mathematical shift is nearly impossible if you are just using a napkin and a calculator. This is exactly why I spent months building the systems I use for my own planning. If you want to move away from guesswork and actually see how your specific numbers hold up against these new rules, you should check out the official Tom Talks Money digital templates. Specifically, the Ultimate Personal Finance Dashboard and the Monthly Budget Planner. These are the exact spreadsheets I use to track my net worth, model my withdrawal strategies, and keep an eye on my actual spending guardrails. They take the complex math we are talking about today and turn it into something you can actually visualize and control. You can find the link to the dashboard and the full suite of trackers in the description below. It is the best way to execute the strategy we are building here today. For years, the stock market run masked the fragility of the retirement math. Then came 2022, and the mask was ripped off. Inflation roared back to 9%, and for the first time in modern memory, both stocks and bonds crashed at the same time. The 60-40 portfolio, which was supposed to be the gold standard of safety, suffered its worst year in history. This created a mathematical disaster for anyone who retired on January 1st of that year. Not only did their portfolio shrink by nearly 20%, but the cost of living spiked. According to the 4% rule, those people had to give themselves a massive raise to keep up with inflation, even though their account balance was bleeding out. This is where we see the real-world impact of what I call the sequence of returns risk. It is the absolute killer of retirement dreams, and most people do not even know it exists until it is too late. Let us look at a quick example to see how the 2022 math actually works. Imagine a retiree named John. He retires with $1 million on the first day of 2022. He takes his $40,000 for the year. By the end of the year, his portfolio has dropped 16%, leaving him with $840,000. But because inflation was 8%, the 4% rule tells him he needs to withdraw $43,200 for 2023. Do the math on that. $43,200 is no longer 4% of his balance. It is 5.1%. In a single year, John has blown past the safety threshold. He is now forced to sell more shares at lower prices just to maintain his lifestyle. This is the death spiral. Once you start selling a larger percentage of a shrinking pie, you lose the ability to benefit when the market eventually recovers. Those shares are gone forever. This brings us to the most important concept in modern retirement math: sequence of returns risk, or SORR. Most people stop their planning at average returns. They think if the market averages 7% over 30 years, they are fine. But in the distribution phase, averages do not matter. The sequence is everything. If you get your bad years at the end of your retirement, you are fine. You already have a massive cushion. But if you get those bad years in the first 5 to 7 years, you are in deep trouble. I have seen two portfolios with the exact same 6% average return have two completely different outcomes. One retiree ends up with double their money, while the other runs out of cash in year 18, simply because the timing of the market crashes was different. This is why the fragile decade, the 5 years before and after you retire, is the most dangerous time for your wealth. Most people miss this and lose $50,000 or more in potential growth. Why is this risk so much higher right now than it was for your parents? It is a combination of two things: high valuations and sticky inflation. When you retire when the market is expensive, you have a much higher statistical chance of a flat or negative decade following your retirement date. If you combine a flat market with 3 or 4% inflation, the math of a fixed withdrawal rate falls apart. You are essentially betting that the next 10 years will look like the 1990s, when all the data suggests they will look more like the 1970s or the early 2000s. Blindly withdrawing 4% today is not a mathematical certainty. It is a gamble on macroeconomic timing. To survive this, we have to move away from static rules and toward what I call dynamic math. We need a system that responds to the market instead of ignoring it. So if 4% is broken, what is the actual number? The latest research from Morningstar and Vanguard suggests that the safe withdrawal rate for a 30-year retirement has settled around 3.8 to 4%, but with a massive caveat. That number only works if you are willing to be flexible. If you want a 90% success rate and you refuse to ever cut your spending, the real safe number might be as low as 3.2%. However, if you are willing to use a dynamic strategy, you can actually start higher. Financial experts now suggest tying your withdrawal rate to the Shiller Cape yield. If stocks are cheap, you can take 5%. If they are expensive, like they are right now, you should probably start at 3.5. This prevents you from overspending when the market is overvalued and setting yourself up for that sequence of returns death spiral we talked about earlier. The most mathematically robust replacement for the 4% rule is something called the Guyton-Klinger Guardrails. This is the strategy I personally find most compelling. Instead of blindly adjusting for inflation, you set guardrails based on your portfolio's performance. This allows you to actually start with a higher withdrawal rate, sometimes as high as 5%, because you have a built-in plan to adjust. The rule is simple. If your portfolio does well and your withdrawal rate drops below a certain point, you give yourself a raise. If the market crashes and your withdrawal rate climbs too high, you take a 10% pay cut. This mimics real life. When times are tough, you tighten your belt. When the markets are booming, you take the extra vacation. By taking small 10% cuts during bear markets, you almost entirely neutralize the risk of running out of money. It stops the death spiral before it even starts. The math of the guardrails works because of a portfolio management rule. You never sell stocks when they are down. You withdraw from your cash and bond buckets first. This allows your equities time to breathe and recover. Most people fail because they panic and sell their winners to fund their life during a crash. But if you have the discipline to follow the guardrail math, you are essentially buying yourself insurance against a 30-year failure. This is why having a dashboard to track these percentages is so vital. You need to know exactly when you hit a guardrail so you can make the adjustment without emotion. It turns a scary market crash into a simple mathematical trigger. It is the difference between feeling like a victim of the economy and feeling like a pilot in control of the plane. Another actionable alternative is the bucket strategy. We have to stop thinking about asset allocation and start thinking about asset location based on time. I like to break a portfolio into 3 buckets. Bucket 1 is your next 2 to 3 years of living expenses, held in ultra-safe cash and treasury bills. Bucket 2 is years 4 through 10, held in income-producing assets like corporate bonds or dividend funds. Bucket 3 is everything else, held in diversified global equities. The math here is elegant. If the stock market crashes tomorrow, you do not care. You have 3 years of cash sitting in bucket 1. You have another 7 years of income in bucket 2. You can wait a full decade for bucket 3 to recover before you ever have to sell a single share of stock. This is how you survive a 2022-style event without breaking your retirement math. We are about to wrap up with the final piece of the puzzle: how to maximize your guaranteed income. But first, I want to invite you to take your financial journey a step further. If you find this kind of deep dive math helpful and you want to support the channel more directly, consider clicking the Join button below to become one of the optimizers. Our members get custom sketch badges and, most importantly, priority replies to their comments. It is where I spend most of my time answering specific questions and looking at the data points you all send over. It is a community for people who want to move past the surface-level advice and really master their numbers. Now, let us talk about the one guaranteed 8% return that the 4% rule completely ignores. The final variable in the new math is longevity. The 4% rule assumes a static 30-year window, but healthcare costs and living to 95 change the equation. The single best mathematical move you can make is delaying Social Security to age 70. Every year you delay past your full retirement age, your benefit increases by a guaranteed 8% plus inflation. There is no investment on earth that offers a risk-free 8% real return. By spending down your IRA or 401k a bit faster in your 60s to bridge the gap, you lock in a massive inflation-adjusted paycheck for the rest of your life. This effectively transfers the risk of living too long from your personal spreadsheet to the government. It is the ultimate safety net for the slow-go and no-go years of retirement, when medical costs tend to spike. The 4% rule was a great starting point for 1994, but financial literacy means evolving with the math. You cannot set your retirement on autopilot in a post-2008 world and expect to arrive safely. You need dynamic spending, time-segmented buckets, and the courage to adjust when the guardrails tell you to. I want to hear from you in the comments. Do you think the 4% rule is still viable for your personal situation? Or have you already moved to a 3% or dynamic model? I treat the comment section like a peer review session, and I learn as much from your data points as you do from mine. Don't forget to check out the digital dashboards in the description if you want to start running these numbers for yourself. I'm Tom, and this has been Tom Talks Money. I'll see you in the next one.